Okay, guys, we just spoke about a credit loss, and we said that was an expense. Okay, do you guys remember what an allowance is? Because this is key. You're going to see other allowances when we look at some examples. The credit loss is an expense. What is the allowance?
Allowance for credit loss.
Yes.
But for the discounts, it's an asset. No. I think you're right.
Okay, when would you want to create an allowance for a credit loss?
Plan around it.
Okay, good. The planning. Okay, so do you always collect your outstanding debtors?
Liability.
No. So liability is a good way of looking at it, but what does that do to my debtors?
Brings them down.
Correct. The allowance reduces your debtors. So in terms of disclosure, it's a negative asset. Same like depreciation. What is depreciation? It's an expense. What is the accumulated depreciation? A negative asset, because the accumulated depreciation reduces the value of the property, plant, and equipment. Okay, so here, what is the credit loss? An expense. What is the allowance for credit loss? It's the negative asset because it reduces the value of your debtors. Okay, it's just related to the depreciation. Depreciation accumulated, credit losses, allowance for credit losses. Alright, so I've tried to define it at the top. Businesses may choose to create an allowance for future periods. Okay, so based on past experience, you might have an indication of how many people aren't, let's say, going to pay. Right, so maybe 5% of your debtors book aren't going to pay, and that's based on past experience. Okay, should you show the full 100% on your statement of financial position? No, I can't show the full 100% because I know from experience 5% are going to default, okay, or go bust. Okay, so because I know that, this year I provide for an allowance. So my statement of financial position is going to accurately show what my debtors are, because I know a certain amount of them aren't going to pay in the future. Okay. So if I adjust, what happens? Well, if I decrease the allowance, I debit it. Okay, just think about what type of account is an allowance. It's an asset. So if it's an asset, what happens to an asset? A negative asset.
Credit asset.
Okay. Plus and minus. Right, so we said this is a negative asset. So if I increase it, I'm going to have to credit it further because that makes the negative bigger. If I decrease it, I'm going to have to debit it because that makes the asset, the negative asset, smaller. Okay, so there's a note about the increase and the decrease. Okay. If an allowance or provision exists when processing actual credit, you can write it off against the allowance. Right, don't worry too much about that because there's two ways of doing it. The net effect is still the same because you're either going to affect debtors or you're going to affect the what? Allowance. Okay, and the allowance is written off against the debtors. Okay, so this is where you put the allowance for credit losses. Okay. Is that alright? You look very tired. Okay. Right, we're almost there, so just push through. We're almost there. Okay. Alright, methods of depreciation, straight line, diminishing balance. Those are the two methods. The one I use cost, the one I use carrying value. How do I calculate carrying value?
Take the accumulated depreciation from the cost.
Yes. Okay. Cost minus accumulated depreciation. I've put a small note here, okay, in terms of scrap value, okay.
Sorry, just to begin, Anthony. I'm a would like to know what is going to be happening tomorrow from 2 until 3.
I'm helping Francois with a question about trial balances, he said, yeah. Okay. All right. Okay, so in terms of diminishing balance, the scrap value is what? Correct. Okay, so do you agree, in terms of depreciation diminishing balance, if there's a scrap value, can I depreciate the asset with the scrap value, or do I have to take the scrap value out? What would you do? It's like a residual value, residual scrap value. Would you depreciate the scrap value? Well, let's just think about depreciation. Depreciation is what? The use of the asset, okay, over its useful life. Okay, so if I don't, the scrap value, do I use the scrap value? No, so would you have to take it out? Yes. Okay, so scrap value is something to consider. If I think back to this module, I think there was only one question in one of the past papers that actually asked about the scrap value. Okay, it's not very popular, but it can come up. I do know though, in second year and later, okay, if you do more accounts, that becomes more of a consideration. Okay. All right. Do you guys remember disposal? You should. You remember it in the exam. You said they gave you a T account for the disposal.
Yeah.
Asset realization.
Yeah.
All right. Is this? Yeah. Is this a separate account?
Yes.
Yes. Does this account have a balance?
Yes.
No. Okay. Why? It's a working account.
So it works out for the other accounts.
Okay, you close off the account. Okay, remember you balance it off. It never. Remember, if you just think about realization, you never have a balance carried down or balance brought down, right?
You have profit or loss.
You have. No. Well, yes, you'd have a profit or loss on sale of the asset, correct? And you'll have accumulated depreciation and cost. That's it. Okay, so you're not going to have an opening or closing balance. All you're going to have is this: accumulated depreciation, cost, and then the profit or the loss. Right? And the reason for that is because I've got carrying value, and if I sell the asset, so if proceeds, I should have added some. I think I did add it on the next page. No, proceeds. If proceeds are greater than carrying value, what do I end up with? Profit. And if it's the opposite, I'll end up with a loss. Yeah. Okay. Right, remember I gave you guys a few additional slides that I mentioned in 1502. I said, you guys aren't going to be tested on this in 1502, but it comes up in 1601. Right, and that's why I said don't get rid of that old textbook too soon, okay? Because that old textbook of yours gives you all of that knowledge in terms of 1502 that you'll need here in 1601. None of that is covered in the new textbook for this module. Okay, so just remember, when looking at non-current assets, okay, a non-current asset can be what? Tangible or intangible. If it's intangible, it could be a website, okay, it could be a copyright, a trademark, a brand, okay. So intangible and tangible are non-current assets. You can also get financial assets, so financial instruments, cash investments, investment in shares. Those would all be considered non-current if they're greater than 12 months. Right, could I have a financial instrument that can be split? Yes. Okay, you can always split these things, long-term and short-term. Okay, that's a possibility. Right, what is the accounting effect on these types of accounts? What's the accounting effect? Debit or credit? Good. Why? It's an asset. Okay, so it doesn't matter what you get, just keep it simple. All right, so when we look at examples, you will see intangible assets. You will see investments in companies or shares or other. Okay, you will see fixed deposits. You will see cash investments. You will see a few other types of assets. Don't worry about what they are. They're just assets. So they're just accounts with debit balances. Okay, if you want to go into more detail, you can, but it's not necessary. You just need to identify the element. That's key, and where to put them out. All right, there's a note about PPE. We spoke about it. That's tangible. And there's a note about intangible. Obviously, things that are what? Can you see and feel those assets? No, they're not real world assets. Okay, goodwill is important because this comes up. We'll look at it. We'll discuss it.
Not charitable.
No, not quite. Okay, goodwill is reputation. Okay, that's pretty much what goodwill is. Okay, we'll discuss goodwill when you look at a partnership. Okay, but I want you to make a note of it now because in this particular chapter, okay, we're looking at assets, types of assets. So is goodwill an asset? Yes, it is. What type of asset is it? It's intangible. I can't see it. Okay, it's brand, it's reputation. So coming back to the example we said, you guys are running a partnership. I want to buy into your partnership. I want a third of the business. Okay, you guys have been operating. Have you created brand, reputation? Yes. Okay, let's say you've been operating for 5-10 years. Right, there's a lot of brand and reputation you've developed. Okay, so if I had to buy a part of your business, I would be buying your goodwill. Okay, I'd be buying into the brand and reputation that you've created. Okay, so we'll look at that in more detail when we look at partnerships. Okay, because partners create goodwill. Okay, companies can also create goodwill, but we don't look at the goodwill relating to CCs and companies, not covered in this chapter, okay, or this module rather. Okay. As much as a financial instrument can be an asset, it can also be a liability.
Sorry, what did you say?
As much as a financial instrument can be an asset, it can also be a liability. Okay, so you do get debentures, okay, you do get bonds, you get long-term, short-term loans, etc. They're all considered liabilities. Assets would be the resources you control that will give you a future economic benefit. Okay, just a note here. Market value and fair value. When you are looking at disclosure, you need to look at the type of asset you're disclosing. Right, and this has become more of a consideration because of what happened in 2008. Okay, what happened in 2008? Correct. Okay, so in 2008 we had the crisis. Why did we have the crisis? It was because of this. The financial assets. Okay, subprime. Okay, subprime mortgage loans. Okay, there were derivatives and other. Okay, not too overcomplicated, just to keep it simple. Those financial assets were toxic. Okay, those loans went bad. Banks were affected. One bank, or there were actually two, Bear Stearns, Lehman Brothers. Okay, those banks went under. Okay, it's because those financial assets weren't worth anything. Okay, market value, fair value, those assets were actually worth zero. Right, so those companies had assets that were worth nothing. Right, and those companies obviously can't operate. If you have assets that are worth nothing, you can't give out deposits. There's no collateral. There's no capital requirements. Okay. All right, then I've got a note here about the adjustments. You didn't have to adjust in 1502. You will have to adjust in 1601. Okay, so the first bit I've given you here is the initial investment. If I buy an investment, I'm going to increase the asset. Okay, we know an asset will generate income. Okay, so hopefully the investment will increase in value, which it should. Okay, if it's a fixed deposit, you should get interest. Alright, so if I'm getting interest, what's going to happen to the investment if I add the value to the asset? Correct. The value of the asset increases. That fixed deposit will be worth more if interest is being added. Okay, so if I have interest income that's being capitalized. Okay, capitalized, we'll talk about capital in terms of a working interest and so on in that final chapter, DSC, right, those chapters. Okay, if I capitalize a return, I add it to the value of the investment. Okay, if you receive the payment, what happens? Bank goes up. Why does bank go up? Because cash is coming in 100%. Alright, so you can either pay it out or you can capitalize it. But both reasons are the same. Asset increase, income increase. That didn't change. Okay, it was just the account being affected. Do I increase the value of the investment, or do I receive the cash in terms of a payment? Okay. Same thing with shares and equity. Okay, this is quite popular. They talk about a gain and a fair value adjustment. Alright, so if I'm looking at an investment, so let's say I've bought shares in company X. Okay, there's the first transaction. You buy shares in company X, debit the investment in company X, credit the bank. Okay, so the one asset goes up, the one asset comes down. You've used cash to buy part of company X. Okay. Does the value of the investment change? Yes, it can. Okay, the value of the investment can go up, and the value of the investment can come down. Okay, so how do I change the value of an investment? Well, what account is it? An asset. If the asset goes up, do I debit or credit? I debit, and that's why I increase the asset and increase the income. Okay, so gain on fair value adjustment is an increase in benefit that you have for having held company X. Okay, so company X is key. X will either increase or decrease depending on the situation. But what happens if we made a bad investment? Okay, so if company X is decreasing in terms of value, okay, so the company is not doing well, the investment drops in value. Is that going to affect me? Yes, you would incur an expense because you would have lost benefit because the investment has lost value. Right, so asset decrease, loss on sale, or not loss on sale, you didn't sell it, loss on fair value adjustment, expense increase. Okay. Alright, then we've got a note here about closing transfers. This is important from a test point of view. Cost of sales. Make sure you remember how to calculate cost of sales using the periodic system. Okay, remember, periodic, how often do I check my inventory? How often do I check inventory with periodic? All the time? No. Okay, I check it in periods. Okay, so maybe once a month I do a stock take. Once a week I do a stock take. Okay, every 2 weeks, depending on the situation, right? Okay, so when looking at periodic, do I have cost of sales? No. So how do I get cost of sales? Do you remember what it is?
Current inventory plus purchases.
Opening stock. Less the purchases, less any
plus the
returns.
purchases.
Sorry, plus purchases,
Yeah.
less any returns, cartage, carriage.
Yes.
Minus closing stock.
Good, that's very close, yeah. So there's the working. Okay, cost of sales. Alright, opening plus purchases minus returns plus any other costs related to the purchase, okay, minus the closing balance for inventory. Okay, good. Alright, just remember, if it's a sale, it's a single part transaction. So you don't record two parts, it's one part. Okay, it's either a debit or a credit. Okay. If you receive the cash, it's bank. If it's on credit, it's debtors. Okay, it's only a single part transaction. So you wouldn't have a cost of sale for a periodic inventory management system. Okay, you do need that formula, so make a note. It is often tested in different questions. Okay. You need to know that cost of sale calculation from the prior module. Okay. Right, where would I work it out? I would work it out in the trading account. Okay, don't worry too much about trading account, but profit and loss is something that we need to look at. Okay, which I didn't put here. I'm going to quickly make a note at the bottom. Profit and loss. The account is a T. Do you agree? Okay. If it's a profit and loss account, what do I see on the debit side? What do I see on the credit side? What do I debit? What do I credit?
Credit, profit, debit, loss.
Okay, how do I work out profit?
Well, sales Sales minus cost of
That's
sales.
gross profit. If I just talk about profit in general,
So your gross profit minus all of your other expenses.
yes, other income, other
Yes.
expenses. So profit and loss, I would have income on the credit side, and I would have expenses on the debit side. Okay, expenses are debits, income are credits. So even in the profit and loss account, you're going to have expenses and income. Okay, the reason why I'm discussing this account is because who gets the profit, guys? The owner, correct. Now what happens if you have more than one owner, i.e. a partnership?
You're going to split it.
Yes, you're going to have to split the profit, but I still work it out the same way. Okay, I'm still going to have a T account, okay, but now I need to share the profit. Okay, so I'm still going to have income, I'm still going to have expenses, but who gets the profit? The partners. Alright, so each partner would get, so capital would be the account that would be affected. Because if you debit the profit and loss, you would do what to capital? You would credit the capital. So if I credit capital with profit and loss, does that increase or decrease? That increases. Okay, so notice a profit would increase your capital. Okay, so the profit and loss account is a simple T account that I use to add up my income and to add up my expenses to get the entitlement of the owner. Okay, whatever's left over gets given to who? The owner. Okay, that's for a sole proprietor. Obviously, we'll look at partners, and partners are multiple. Okay, so you might have 2, 3, 4 partners or more, right? You'll then allocate a share of the profit. So I'm showing this here because this capital here can be split or shared between different partners. Okay, because you'll have maybe 3 line items, partner A, partner B, partner C. All 3 are going to be getting a portion of the profit. Okay. Right, then I've tried to summarize here for you. So I've given you guys a table of accounts. Alright, assets, liabilities, income, expenses. Okay, in 1502, right, you had to complete the table. Right, so I've tried to put as much as I can on, right, in terms of accounts that you'll see when we start looking at the new material. Okay, so what I've covered tonight is study unit 1, the introduction. Okay, they talk about statements. So know what the statements are. You've got 4. Okay, 3 you've looked at previously. Comprehensive income, financial position, and change in equity. The new one that you haven't looked at is cash flow, which we need to cover in study unit 7. That's a standalone. Okay, make sure you know what all these accounts are in terms of account elements. Okay, notice the headings here are there to identify what they are. I know those are assets. All of them are assets. Okay, a lot of them we spoke about tonight. Debtors we spoke about. Prepaid expenses, accrued expenses. Okay, same thing here with expenses. Everything under that column is an expense. Depreciation, loss on sale, discounts. Okay, don't forget those discounts. Okay, I didn't give you a separate slide on it. It does come up from time to time. Okay, if it does, it's an expense. Okay, if you're allowing a discount, are you losing out or are you gaining something? You're losing something. Okay, you're not getting the full payment when a debtor pays you. Okay, so those are some of the accounts. The ones that I've bolded, so those 2, okay, are special accounts that were talked about in 1502, but you weren't tested on them. Okay, you never ever saw a gain on fair value adjustment in any of the past papers. It just wasn't covered. Okay, but it is part of the theory and the content. Okay, here it's covered. Okay, they do give you adjustments. So the investment goes up, the investment goes down. Is that a gain or a loss? Is that an income or an expense? Okay. Alright guys, then there is some assumed knowledge that obviously we've covered tonight. If there's anything that you're still struggling with, let me know. Okay.